Today, I want to walk you through one of the craziest hedge fund stories that I've heard in years. This fund goes from being one of the hottest names on Wall Street, managing more than $20 billion, posting incredible returns, then within just a few days, everything falls apart. We're talking about a guy who's 24 years old. 4 years ago, he was graduating college. 2 years ago, he got fired from OpenAI. And by this month, the fund that he built was reportedly worth as much as $45 billion. Then on Thursday morning, it sold its entire public portfolio. It liquidated billions of dollars of longs and shorts in what one CNBC reporter called one enormous trade. And the firm that bought the wreckage? Ken Griffin's Citadel Securities. Now here's the thing. There's a clean version of this story, then there's the conspiracy version. I'm gonna give you both here today. I'm gonna be honest with you about which parts are confirmed and which parts are people on the internet connecting the dots. So let's get right into it. So first things first, who the hell is this guy and how the hell you pronounce his name? His name is Leopold Aschenbrenner. Born in Germany around 2001, graduated from Columbia as a valedictorian at 19 years old. Before all of this, he spent time at the philanthropy arm of Sam Bankman-Fried's FTX, that same FTX right before it collapsed. Then he joined OpenAI, the company behind ChatGPT, on their super alignment team. The group focused on AI safety. He was fired in April of 2024. OpenAI said that it was over an alleged information leak, but he disputes that. Here's where it gets interesting. 2 months after getting fired, he publishes a 165-page essay called Situational Awareness, the decade ahead. His bet is that AGI, which is human-level superintelligence, is coming around 2027 and the world isn't ready yet. And whoever builds the physical infrastructure for it makes an absolute fortune. The essay went mega viral. It got him taken seriously by the tech CEOs and the investors of the world. And then he did the thing that almost nobody does with a viral manifesto. He turned it into a hedge fund, baby. And you know what the name was? Situational Awareness LP. He made himself the chief investment officer in his early 20s with no real prior financial track record. And the craziest part is his earliest backers were not nobodies. They were actually smart, well-known people. We're talking about the brothers who founded Stripe, the former GitHub CEO, Nat Friedman, and investor Daniel Gross. Serious money took him seriously. And to be fair, for a while it worked spectacularly. Let's talk about how the fund actually made money, because this is the whole story. The strategy wasn't pure concentration and AI conviction. Instead of the obvious mega cap names, the bets were on AI infrastructure, the chips, the memory, the data centers, the power. It's the picks and shovels layer underneath the whole AI boom. And the concentration here is wild. According to public filings, his single largest position was Nebius, ticker symbol NBIS, a pure play AI cloud company spun out of the old Yandex. And at one point, that one stock was reportedly around 40% of the entire portfolio. 40% in one name. His other big disclosed holdings included SanDisk, SNDK, the memory chip maker, along with Micron, CoreWeave, and SK Hynix in Korea. They're all infrastructure names, all levered to the exact same AI build-out thesis. That concentration is the fuel, and it's also the bomb. When your book is that lopsided, it's all the same bet. You don't have a portfolio, you have a giant trade wearing a trench coat. When it works, I mean, it really works. But when it turns, there's nothing to cushion you. And on the other side of the book, he was shorting, meaning betting against legacy software companies that he thought AI was going to eat up. Names like Adobe. Now here's the number that actually matters. Through the first half of 2026, the fund reportedly returned 439% net. It grew from roughly $225 million at launch to somewhere between $20 and $24 billion. And reportedly as high as $45 billion at the very start of July 2026. So how do you get returns like that? One word, leverage. Let me explain leverage simply, because it's the villain of this whole story. Charlie Munger actually once said the 3 L's that could make you go broke are liquor, leverage, and ladies. Leverage means trading with borrowed money. If you have $1 and you borrow 3 more, you're now controlling $4 with one of your own. That's called 4x leverage. That's reportedly roughly what the fund was running. 4 times leverage. Here's the catch. Leverage multiplies your wins and also your losses. If your $4 of exposure go up 25%, you made $1. You doubled your actual money. But if that exposure drops 25%, your original $1 is gone, wiped out, and the money you borrowed comes from prime brokers. Think about big banks like Goldman Sachs, JP Morgan, and Bank of America. When your position starts losing, those brokers make a margin call. They say you have to put up more cash right now or we sell your positions against your will. That's the mechanism. That is the tripwire. Remember that, because that's where it's about to all go off the rails. Okay, set the scene for late July. The backdrop. Kevin Warsh is a new Federal Reserve chair sworn in back in May of 2026. And he's got a reputation as a hawk, meaning someone who's more inclined to raise interest rates than to hold them high to fight inflation. Rising rates are generally bad for the exact kind of high growth, speculative AI stocks that this fund was loaded up on. Now here's the first rumor, and I want to make this clear. This part is market chatter, but not confirmed reporting. On July 28th, there were some big players talking. Citadel's name gets thrown around. They were betting that the market would drop with a surprise hawkish move. Now, it was confirmed that Citadel announced that there might be a surprise rate hike. It was not confirmed that they went short ahead of this, but if you put your little tinfoil hat on, I'm sure you could assume what happened next. Here's something to keep in mind as well. When a fund this big is in trouble and about to dump its portfolio, that book doesn't just hit the market out of nowhere. Before a fire sale like this, the position gets quietly shopped around to different hedge funds. The prime brokers go to other big funds and basically ask, hey, do you want a piece of this book? That is real. That happens all the time on Wall Street. And think about what that means. Now, a handful of funds know that a giant forced seller is coming into the market. When the ones who say no to buying still have the information, they know that a wave of selling is about to hit specific names. So some of these funds then turn around and short the market, knowing that a big seller is about to crush the price. Again, this is all just assumptions. I'm not telling you that I have proof of this, but I'm sure you can make some guesses here. You need to understand that mechanism in your head to understand what happens next. Because whatever the trigger was, Fed fears, the broader AI sell-off, Asian markets rolling over, a tech and AI trade that cracked in late July, and a fund running on 4 times leverage on concentrated AI bets is the most fragile thing in the room when that happens. Here's the confirmed sequence. The AI sell-off hits, and his infrastructure longs get demolished. Nebius, SanDisk, Micron, CoreWeave, reportedly all down more than 35% in a single month. SanDisk alone was reportedly off more than 50%. And remember, Nebius was something like 40% of his entire portfolio. So when that one craters, the whole fund craters with it. And at the same time, his shorts go the wrong way too. Some of the software names that he bet against, like Adobe, moved up against him. That is a nightmare scenario. You lose both on the long side of the book and on the short side of the book. Then leverage turns that from a bad week into an extinction event. On July 24th, Aschenbrenner sends investors a letter, and it's defiant. He argues that the dip is actually the best entry point for AI investments in over a year, and he points to a possible Anthropic IPO as a future catalyst. He gives existing investors until August 1st to add more capital. In other words, he's asking for more money to hold the line, baby. It doesn't hold. The margin calls come in. Per CNBC, the prime brokers of Bank of America, Goldman Sachs, and JP Morgan are scrambling with the fund to either meet those calls or wind down the positions in an orderly way. The fund even reportedly tries to sell stakes in private companies, including its stake in Anthropic, just to raise some cash. And then before Thursday's market open, on July 30th, it's over. CNBC's David Faber reported that the fund exited all of its public investments and the liquidation was done. In his words, through one enormous trade. Roughly 2/3 of the fund's assets were public equities. All of it gone in one single transaction. So who's on the other side of the one enormous trade? The Wall Street Journal and CNBC reported that the buyer was Citadel, Ken Griffin's firm, which acquired most of Situational Awareness's publicly traded portfolio. And here's where that same Thursday morning gets weird. As the unwind is happening, a bunch of the AI infrastructure names associated with the fund rip higher. By late morning, most of these stocks were up 15 to 20% in one day. Now here's the conspiracy version that I promised you. The theory going around is this. Citadel announces that the Federal Reserve is potentially going to raise rates. They short the market and force so many of these names that Leopold bought in his portfolio to crater down. Then he used those acquired holdings to cover its own short position. They shorted the money so big ahead of their own rumors that they needed his entire fund to be wiped out to then use that wipeout as their exit to cover the short. Remember, to exit a short, you have to buy to close it up. So if Leopold was selling his portfolio, Citadel was buying to cover up those shorts. That's then what drove up the price higher, which makes them even more money. So within 3 days, they set up one of the biggest hedge fund heists in history. They front ran the pain and then they feasted on it. Could the spicier version have some truth to it? I mean, maybe. Big funds absolutely do get early looks at portfolios being shopped around before a fire sale. That part is a real dynamic in how Wall Street works. But remember, because this dynamic exists, it's not the same as here's proof that it actually happened. It's a pretty interesting coincidence. So what actually happened here? A 24-year-old with a viral essay and no finance background built a $45 billion fund on one idea and a mountain of borrowed money. That leverage made him look like a genius for 18 months. And that same exact leverage detonated the whole thing in a matter of weeks. Margin calls and a forced fire sale. The entire portfolio gone in a single trade right before the market even opened. Some people are calling it Archegos 2.0 after the last time a hugely levered hedge fund got liquidated. That comparison feels about right. And the lesson here isn't AI is wrong or he was dumb. His thesis is probably right long term. The lesson is the oldest one in the business. Leverage doesn't care if you're right eventually. It only cares if you could survive the drawdown in the middle. He couldn't. So if you got value out of this video, leave a like, leave a comment, and subscribe to the channel. I break down this stuff the same way that I trade it. Honestly, I have live trading videos here, day in the life vlogs here, and a bunch of other stuff. I'll see you on the next video.